The US money supply is contracting at an alarming rate, and this is the first time the money supply has contracted since the Great Depression. Throughout history, the 3 other times the money supply contracted, we had huge unemployment, a depression, and a major banking crisis. And given what happened in the first half of this year, does that sound familiar to you? The reality is that if the money supply keeps contracting and the Federal Reserve keeps sucking money out of the system, more banks will fail and the chances of a massive recession or even a depression with double-digit unemployment numbers will increase significantly. So how does something like this happen? It's like the inner workings of the financial and banking system is like a bunch of dominoes just waiting to fall. And thus far, they seem to be falling one after another. We have money supply contraction, and then we have big bank failures, to name a few, like Silicon Valley Bank and First Republic. Now, along with a credit crisis where banks are saying they're not going to lend any more money. But in the long run, it's bank lending and credit which sustains an economy. You need banks to lend money in order for the economy to grow. If businesses can't borrow and businesses can't refinance their debt, they're going to lay off workers and some of them will shut down. This can be one hell of a vicious cycle because if banks cut back on lending, that's going to contract the money supply even more, leading to lower deposits and then more bank runs, which is going to cause more banks to fail. And then they're going to cut back on lending even more. And then the money supply is going to go down by more again. And that's basically how you get a depression. And what's really scary is that no one's paying attention to this. It's like the warning signs of a depression are right there, the first depression in 100 years, and nobody is paying attention. The Fed's not talking about it. The mainstream financial news is not talking about it. Everyone is more focused on the good reports that keep coming out, such as stronger than expected GDP, stronger than expected job market, disinflation meeting expectations. That may be true, but is all that enough to counterbalance all this negative stuff and bring us in for a soft landing? That remains to be seen. And really, folks, you don't have to wait too long to see it because all this is going to happen in the second half of this year, which is starting right now. So that is how it happens. But what is causing it? What is the root of all this? Well, to find out, we have to look toward the Fed. It would seem like they're actively making the situation worse through their monetary policy. Not only through hiking interest rates, but through their quantitative tightening. That tightening is what's destroying money. You can see that destruction by looking at the Fed's balance sheet. The assets on the Fed's balance sheet are in general going down. And the way this works is that during the pandemic, the Fed printed money by basically buying bonds and mortgage-backed securities. The US government issued debt, or a bank made a mortgage, and the Fed just bought it with printed cash. That's how the Fed increased the money supply during the pandemic. But what they're doing now is when those bonds or mortgage-backed securities mature, and the US government or the bank that made the mortgage has to pay back the Fed isn't putting that money back into the system. They're just letting the money disappear, which is how we get the scenario of money supply contraction. And so this is clear, in your life right now, it's going to be difficult to see all of these realities. Like if you go to a restaurant to eat out, or if you go to rent an apartment or to buy a house, things still seem very expensive. They are very expensive, and it might not feel like the money supply is going down. It might not feel like there are deflationary forces present in the economy. But we need to understand that there's a lag from monetary policy actions to inflation and their effects on the economy. According to Milton Friedman, it takes over a year for monetary policy actions to have their peak effect on the economy. So what that means is that the money supply contraction today and over the last 6 months is going to turn into lower inflation and quite possibly deflation in America over the second half of this year and in the beginning of 2024. Now, we're already starting to see lower inflation. The disinflation is happening and has become invisible to pretty much everybody. But let's be clear on what lower inflation means in contrast to deflation. Lower inflation or disinflation means that the inflation is decreasing month over month or year over year. That means that prices are still expensive, but the rate at which those prices increase is slowing down. This is actually a good thing, even though prices are still expensive. Deflation, on the other hand, is when prices start going down. And for those who weren't taught about finance in government schools, which is pretty much everybody, this is actually a bad thing. The reason why prices going down is actually a bad thing is because everybody's losing their jobs and nobody can buy anything, and investors don't want to invest their money because it's more valuable to hold on to it. When it comes to increases of money supply, we've always seen this happen. The money supply grows first. Like during World War II in 1943, it grew by 18%. We had to finance the war, of course, and then it was 2 to 3 years later where we saw peak inflation. In the 70s, we had a decade of inflation. The money supply grew by 13% in 1971, and that happened 2 to 3 years before peak inflation. Then there was another peak in money supply in 1976, and then again, inflation then peaked 3 years later. Today, we're in a situation where the money supply growth peaked in 2020, and it has now gone negative, indicating that this inflation will continue to decelerate and possibly decline into deflation. The last time it went negative wasn't in the 70s. And it wasn't in the 40s, it was in the 30s during the Great Depression. And the prospect of deflation sounds good on the surface because it's going to mean a lower price of goods. It's going to mean lower rent. It's going to mean lower home prices. But what goes along with deflation, especially in a debt-ridden economy like ours, is huge increases in unemployment and corporate bankruptcies. We're not going to get deflation without some big problem in the economy. And understand that this is a big warning signal for economic turbulence. Only 4 of the times in U.S. history where the money supply contracted, the unemployment rate was 25%, 11%, 18%, and 24%. And those are very different unemployment numbers from where we are at today. And you have to imagine that this is now scaring many banks in America, especially regional banks. Regional banks, which are the ones that do most of the lending in the economy, you can bet that their CEOs and their risk officers are saying, hold on, let's tighten our lending. Let's pull back on making new loans. Let's increase our underwriting standards and increase our cash balances. Let's make sure that all of this doesn't happen to us. This is good because they're trying not to collapse, which would cause these dominoes to continue to fall. But then again, lending is what sustains the economy. Now, of course, the Fed can pivot their stance, right? Their hawkish stance. This isn't a guarantee that it's going to continue to flow this way. The Fed can make a decision in a month or two to cut rates and turn that money printer back on. So maybe they'll turn the money printer back on and eventually we'll reverse all of this. If a lot of what I described here will continue to show and get worse, then it probably might happen. However, in the short term, it seems that Jerome Powell is committed to getting inflation down to 2%. And it's actually kind of scary because he's so committed and the market is buying into what he's saying so much that they're ignoring all the major warning signals. Personally, I'd rather deal with 9% inflation in a good economy than deflation in a bad economy. But hey, let me know your thoughts in the comments below. For me, I think deflation is frightening because when the banking system starts to have problems, it could really negatively affect all corners of society and life. Like, what could you do? You lose your job and then you can't get money out of the bank and your credit cards don't work. If you have a small business and no one else is buying from you because everybody's losing their job, you can't just bounce back from the situation within a couple of months. So yeah, it's kind of scary. By the way, thanks for watching and be sure to hit that like button.